All right, welcome back, everyone. We've covered a lot of ground today so far. We covered COVID-19 with Dr. Arkin, government policy with Dr. Laffer, macroeconomics and volatility in the markets with Catherine Wood, and now we're going to bring it home with our last session with ARK's Director of Research, Brett Winton, focusing on innovation. And Brett has worked alongside Kathy now for over 13 years, including their time together at AllianceBernstein. He's been the director of research for ARK since the beginning and directs ARK's proprietary research and the investment team with the demands on a dynamic and universal approach of covering innovation. By researching across sectors, industries, and markets, ARK seeks to gain a deeper understanding of the convergence and market potential of disruptive innovations, and thus size the investment opportunities more appropriately. And that is at the direction of Brett. So welcome, Brett. Thank you for joining us today.
Thanks, Tom.
So let's get started with, obviously, amongst the time of turmoil, amongst the crisis, has this caused ARK's focus on the areas of innovation to shift? ARK has certainly always been known for its bullish outlook on a number of technologies, including autonomous driving. But has this caused you to focus more on healthcare or food delivery or streaming or online education?
Well, I mean, what we've done is thought about what has structurally shifted over our investment time horizon. So we don't. One thing I really try to guard against is what can be a real temptation of, oh, this is the thing that's going on now, so this is the thing I'm going to focus on right now. So instead, as we're going through a period of turmoil, and a period of turmoil that is fairly likely to fundamentally shift some consumer behavior, even over our longer term time horizon, the question we've been asking is, how have the structural dynamics shifted such that 3 years from now, you'll say, oh, this was really something different from 1 year ago. And that's very different than saying, oh, suddenly everybody is going to spend the next 4 years of their lives stuck inside their houses, and what are the things that they're going to consume inside their houses that they weren't going to consume. And so kind of that's from a high level how we've approached it. I think Kathy kind of talked a few times about this, but on a fundamental basis, disruptive innovation takes share during these time periods because it's unit economic cheaper, and people really have a status quo bias. The decision that they've made is one that they would prefer to stick with. So if you were to wipe the slate clean, a lot of the technologies that we're interested in actually do a lot better on a clean slate perspective. And so to some degree, what's going on right now is causing people to reassess, sometimes forcibly, kind of what they're spending money on, whether or not it's giving them the bang for the buck. A business that goes bankrupt is replaced by a new business that then remakes a lot of decisions that business made 5 and 10 years ago. And so, those remade decisions are going to be with kind of the modern implementations that cost them less rather than kind of legacy decisions that get carried forward into the future. And so kind of, it's a long way of circling back to our fundamental focus hasn't changed. Some of our forecasts have shifted around as a result of the crisis, but we're still focused on the same technology platforms.
So maybe let's talk about some of those shifts that you just referenced. Is it the timelines? Do timelines that ARK has publicly stated or looked at for the innovation platforms, have they had to been pushed back? Is that what we're talking about?
Well, it's a mix. I think from a very high level, you can say generally what's happened to our forecast is you lose like 6 months or 9 months worth of growth, which would tend to push whatever end market you're trying to address out to some degree. But then the adoption curves for the individual technologies is often getting pulled forward because during this last year of growth, often the technologies we're interested in take a lot of share. You can see, like an obvious example is streaming media companies. Netflix is adding a bunch of users. Zoom, the video conferencing software, added an absurd number of users over a very short time because of kind of the tumult that we're going through. But just to go through technology by technology within robotics, I think for one thing, you will see the companies that are more heavily roboticized in their manufacturing processes do better through this period because they have less. The workers can actually safely stay farther apart and still manufacture the products. You also may see kind of the, I guess, political pushback against roboticization of manufacturing and delivery get a little weaker, given that, we clearly need to be able to operate even in circumstances where people's ability to actually be in a factory are constrained. Within energy storage, I think at-home energy storage is going to get a boost out of this, whereas and utility scale as well seems to be pushing ahead. People are more sensitive to basically making themselves more robust to disruption. I think clearly the automotive space, maybe we'll have time to talk about it later, is going to be disastrously impacted by this in the near term. I think electric vehicles are likely to take share since they're more supply constrained relative to general vehicles. AI, I mentioned video conferencing. A lot of kind of adoption of software as a service and enterprise software will provide a lot more data to then be fed into AI engines to improve those products. So it actually probably accelerates AI relative to the other technologies we're interested in. Genomics, I mean, the genomics offers a solution to the problem. So particularly in the genomics tooling space, we think it's, if anything, an accelerant. Some of the clinical trials are likely to be delayed just because they can't get patients in to participate in the trials right now. So that's been pushed out maybe 6 months. And then blockchain and digital wallets, I think it seems fairly likely that at the tail end of this, people will have a lot more of an appreciation for a bearer asset that you can transfer on your own without having to rely upon a third party that stores value. So there, effectively, our forecast hasn't changed, but I'd say addressable market is probably larger.
Well, let's narrow in on one of those that has certainly been on the top of minds for most people and certainly gotten a lot of coverage. We've heard a lot about how genomics sequencing and the improvements in the technology helped us sequence COVID a lot faster than what previous outbreaks, such as SARS, that they were able to. So building on that, how are innovations in genomics in general and biotech helping with this crisis? And then what are the opportunities that will be built off the momentum and gains they make during this period?
I think you can classify the way that the genomic technologies have and are and will help with this crisis into 3 buckets. The first is, like you said, identifying what's going on and helping to track the spread. So being able to sequence the virus, within a couple of days is a big change to how we could have done it in the past. Also, the different strains of the virus helped us understand, where it had spread when, and helps to continue to track the spread. It seems clear that to tamp down coronavirus, you're going to need a massive ongoing diagnostic effort. And so, there's a few critical technologies in the synthetic biology space that help you to create quick diagnostics as well. CRISPR actually can be used to do a quick diagnostic as well. There's another company working on that. Also within our we think of genomics, not just genomics, but also the bioinformatics platforms that help with health outcomes. And so there are wearables that can measure, for instance, your temperature and also could serve as a critical kind of diagnostic tool to help people know that they're experiencing symptoms before they might even realize it. And so then let them know, they need to get tested. They need to stay home from work. We think this will not only help with coronavirus, but it actually could provide economic productivity going forward. If it becomes culturally unacceptable to go to work when you have a fever and you have a device that tells you have a fever, and so to stay home, then it can reduce transmission of flu and all other kinds of other transmissible diseases that are costing employers. The flu, it's billions of dollars a year in lost productivity, particularly when you're bringing it into the office and spreading to everybody. And then there's the treatment and vaccine, and where the ability to do RNA and DNA vaccines is fundamentally new and holds the promise to kind of provide a vaccine a lot more quickly than we otherwise would be able to kind of get to that answer.
Focusing on another technology, we heard Kathy just a second ago talk about how cash is a super spreader of germs, but also that some amazingly high number of transactions and of dollar amounts of transactions are still performed in cash. And sitting in New York, where we are, it's still illegal to not offer cash in many transactions in certain situations. But a crisis brings an opportunity to do things differently. And so do you believe this crisis is going to increase the pace for fintech, or at least disruption within financial services industry as a whole?
Yeah, on a couple of fronts. I mean, you mentioned kind of the regulatory front, where I think broadly policymakers are going to reconsider some of the kind of pronouncements they've made about whether something is or is not allowed, taking into account that it actually may make kind of society weaker if something is still required. So clearly there's been a lot of adoption of contactless and peer-to-peer payments, and this is accelerating that. I think Square's Cash App has had record weeks in terms of customer acquisition during this time. And the within financial services generally, we believe that fast forward 5 years, everybody is going to be banking out of an app in their pocket, basically. And so, this is going to be your bank branch. And there are certain companies that are well positioned to take advantage of that opportunity. And then there's a whole class of retail banking franchises in the US that have more than $100 billion of bank branches, each of which requires 7.5 employees and has a cost $1 million or so to build out, that are legacy assets that are going to be severely impaired in a likely future in which those are no longer mechanisms by which to acquire banking customers and then provide them with financial services. So it's not just on the kind of deposit and cash ATM dispensement side, also on the loan side. If you are a small business lender and you're trying to evaluate whether or not to give a company a loan today, you really want to know kind of what is their cash flow over the past week, and what are their kind of, if they shift over to a delivery, say it's a restaurant, shift over to a delivery only format or a delivery and kind of grocery type format, what is it likely to do to their business prospects? A traditional bank has no idea. They have no idea what that looks like. Whereas a Square, which gets real-time feeds off of their businesses where they have point of sale, and they can provide you the software by which to make that transition, has a much better understanding of what the cash flow dynamics of that business might look like. And so is much better placed to then make that instantaneous loan decision than a traditional lender. And so generally digitally instrumented fintech companies should outperform kind of more legacy. We are relying on old data sources and physical infrastructure financial companies as we move through this crisis.
It's interesting. In the early days, we heard of stories of runs on ATMs and lines around the corner. But it seems like since then, everybody seems to remember that their Venmo and their Square Cash App and their online mobile banking still works.
Yeah, I mean, it's like you're just trying to make yourself a robbery target and super spreading the virus at the same time. Bad choice.
Another technology, and this is one that's interesting for me personally. My wife works in a hospital, and she came home and said, I've been hearing a lot about this 3D printing all throughout our hospital. It's one that certainly picked up a concrete example, just another one of a technology that's getting a lot of coverage. It's picking up during the outbreak because there's a shortage of medical equipment. And so how does 3D printing take this moment, take this opportunity, and really build to achieve some of the promise that has been forecasted and been talked about for a little while now?
Yeah, I think it's really fascinating. And the medical example is illustrative and interesting, and clearly critical at this time, where it's like a 3D printed respirator part could mean the difference between somebody living or dying. And for the nurses and doctors being able to 3D print the brackets for their masks and stuff so that they have a better fit, also can protect them or expose them to the virus. But there's also, I think, measured over our time horizon, companies across the board are going to assess the brittleness of their supply chains. When this was first moving through China and people were, suddenly not able to get parts out of China, and as this has restricted travel in various parts of the world, you've had problems with manufacturing goods. And so supply chains are so fascinating because imagine you have something that you're building that requires 500 parts, that you have carefully negotiated these great deals where each part is cost, to the fraction of a cent, but only 499 of those parts are able to be produced. You can't get that 500th part. You don't get to sell the product with just 499 of the parts in it. You lose the entire sale. So suddenly you'd be willing to pay a lot of money for that one part so you can actually complete your sale. Well, additive manufacturing, 3D printing, gives you kind of a tool that can potentially, at a higher cost, fill in that end part in the event of that emergency. So it almost can serve as a supply chain insurance product. And so I think that companies are going to see that role it can fill and begin to design it in, not as a primary end part manufacturing device, but as an emergency end part manufacturing device. And then from there, they'll move to saying, hey, well, with this capability, I can design in a lot more part complexity. Maybe I can actually turn this into the primary manufacturing capability and take advantage of the unique aspects of 3D printing to actually make my end product better. And so we think it's a point of entry for 3D printing into the end part market, which is a 500 billion annual market. And so and it's really critical to the medium term forecast as to the degree to which it works into those end parts. And so to me, it's an example where you react to the immediate disruption by thinking, okay, how do I need to structurally change to fight this last war? But then it opens up opportunity for you, the business, and for the technology itself to actually take meaningfully more economic share over the medium term.
So another one you've kind of talked about, and it actually builds on the 3D printing quite nicely, is the auto industry and the global car market. Certainly, it is impacted by the credit markets. It's impacted by this global health crisis. How do you see, as a whole, the car market shaking out really during this, but also really even when this crisis is over? What happens to autos?
Yeah. Well, I mean, the during is clearly like kind of harrowing. Like the combination of high auto loans, generally, at least in the U.S. economy, high exposure of auto loans from the traditional to auto loans amongst the traditional manufacturers, a clear, huge downtick in sales, and balance sheets that are somewhat bloated. I think it's going to be likely that not everybody comes out of this alive. I do believe that because electric vehicles have been supply constrained, that they're likely to actually take share during this time on a global basis. But then over the medium term, I actually think, and this is maybe contrary to consensus, I think the value of a vehicle will actually be enhanced over the medium term. I think more people will rely on cars after this than relied on it beforehand, for a couple of reasons. One, people aren't going to want to get into, there's a trade-off. If you decide to go to Las Vegas from Los Angeles to Las Vegas, you can either fly for an hour or you can drive for 4 or 5. People are probably more likely to decide to be in their own little non-virus pod going from LA to Las Vegas after this, rather than take that hour-long flight. And so there will be more kind of road travel intra-city, I think, at the end of this. And then there's probably at the margins more people deciding to either have a vacation home or live in the suburbs rather than in the city, in response to having been cooped up in their apartments for the last 2 months and being like, I never want to see the inside of this house again. And so then that makes them a marginal car purchaser. And so I think that there's, likely to be actually more car intensity in the economy after all of this. The other angle that people often ask about is oil prices at like $10 or -$1, whatever they're at now. What does that do to marginal EV purchasing? And I'm firmly convinced that consumers don't do complicated math when they buy a car. So our expectations for electric vehicles is not contingent on them saying, I'm going to save this much money over time. It's really how good is this product for the amount I have to pay up front? And so we think electric vehicles are going to be cheaper than a Toyota Camry by 2022. And so that people will just buy the electric vehicle for less money up front and then save money over time, rather than saying, oh, this is how much I'm going to save. And so it doesn't meaningfully impact our forecast on that basis.
What about the forecast for Bitcoin? Or is it still too young to benefit from a global crisis like this? Do you see the progress being made? Does a crisis lead to more widespread adoption of Bitcoin, or does this one need the next crisis?
I mean, I think it's both too young and it's going to see a lot more adoption out of this. Like Bitcoin, given its current liquidity profile, is still too small for the largest institutional buyers to get themselves a meaningful allocation into it. However, given what's happening to the balance sheets of reserve banks around the world, like given the amount of money printing that's going on, anybody that has a marginal distrust of kind of your ability to control whatever happens on the other side of this is likely to want to have a digital bearer asset that they have entire control over. And there's also, it's not unreasonable to think that in some future worlds, emerging market countries get put under severe stress by the coronavirus. And so if you see kind of an emerging market currency crisis result out of this, which could happen, I think that's where you really end up with kind of structural adoption of digital currencies in some way. At the very least, I think it's fair to say that as an insurance product against basically monetary uncertainty, you have to think that the value of cryptocurrencies is higher today than it was, 3 months ago, just because there is much more uncertainty in your forecast about like, what is the value of fiat currency at the end of this? What are the, just to throw out a random example, what if there becomes like a succession movement of California from the rest of the US? Like, how politically destructive is this crisis to the political bodies that we understand today? And then given that as kind of an uncertainty backdrop, it would seem reasonable to hedge yourself with something, with a currency without a country, right? With a currency that doesn't actually have the kind of political borders that these other places have. And so kind of measured over, 3 and 5 years, to me, it's, it's interesting. The counter argument people would make is, oh, Bitcoin fell like 40% overnight in the midst of this as, some leverage there was unwinding and everything else. And so that's indicative of how early it still is for that entity and for the entire crypto asset landscape that kind of pricing action could happen. But I think over the medium term, you'll say, oh, this was another kind of mark in the or milepost on these things are interesting and unique, and they're going to have value going forward.
So as we get close to wrapping up here, when you look at disruptive companies, in many cases disruptive, but fairly immature or early stage, however you want to call it, companies have negative cash. So from ARK's standpoint, which areas will be most impacted and affected by the financial market disruptions that we're seeing today?
Right. I mean, I think, like you said, we invest in companies that are predicated on a future that's going to happen 5 years from now. If everybody else in the world, doesn't think they're going to survive for 5 years, so they don't care what 5 years looks like, they want cash flow today, that's going to disproportionately impact the kinds of companies that we invest in, right? Like, so, who cares about 5 years from now? I want a dividend. And so the kinds of technologies and the companies tied to them get disproportionately hurt by the stock market. And they are sometimes balance sheet sensitive. And so, we do a lot of work to assess that balance sheet sensitivity. We make assumptions about kind of the dilution that you'll get coming through the models as a result of this, as a result of equity issuance that might happen during this time. And then that feeds through into our 5-year valuation. On the other hand, I often, like, the market's latest mania seems to price assets as if literally there isn't a future 5 years from now. Meanwhile, the result of that is the 10-year treasury and the 30-year treasury trades down at like 1%. Think about the value of that platform, that technology platform, if your alternative is to yield at something like 1%. So actually the normal multiple you should pay for these platforms is higher, so long as that future comes to pass. And so kind of that's the dance we do with our evaluation models, is kind of assessing balance sheet risk, saying how much more dilution do you anticipate, and then actually what does a rational market participant pay on the back end for growth in a world that is forecasting deflation. And kind of the result often is you are buying shares of platforms at what we would consider deep value relative to what they're likely to be worth in the future.
So let's wrap it up by talking about that future. Obviously, this event today was planned to be in person, and instead it's an online event where we've been able to reach far more people than we could have gotten to Columbia University. We've seen colleges go to completely online education. We've seen our business, like probably most people listening today, completely working remotely or from home. And so what are some of those successful forms of innovation that you see in this crisis that are going to permanently impact and change American life moving forward?
Well, first of all, I think you bring up a really good point. Imagine if this had happened 20 years ago. Imagine if I didn't have my work computer basically portable, if I didn't have a smartphone, if I was trying to operate with like a Motorola Razr right now, like we would have been in so much worse shape right now if the crisis had happened, even 10 years ago. Like, so the robustness, at least of the kind of knowledge economy to this kind of disruption is a testament to the technology stack that we're operating on now relative to where we were. I think that for us as a business, like the transition has been relatively seamless. For the research team, we were already doing great document management and using software as a service and already doing video calls all the time. So it actually hasn't disrupted us at all, which has been affirming. I think for kind of the broader economy, I do think that there is going to be a great sorting between companies that were already kind of front-footed in terms of using technology to inform their products and services, and their own internal operations and agility, because they will be able to more agilely navigate this crisis, versus companies that had a lot of legacy infrastructure in place. And so then we're hit by this thing and actually weren't ready to like distribute their workforce and still operate. And so are suddenly trying to like essentially fix the airplane engine while the plane is still flying. Like you could see some companies stumble from an execution perspective that you otherwise wouldn't expect to stumble, just because their own kind of operating stack was built on a platform of decisions that were made 20 years ago. So there could be some surprising results out of that. But the other side of that coin is it means there's going to be also a lot of competitive openings that suddenly unveil themselves that you wouldn't have expected to occur. And so, from our perspective, we think that, the companies that are like building technology tend to also be the companies that use technology to get to the next step. And so there's a nice synergy where it's like technology platform companies are then much more agile when you suddenly turn over the entire game board. And so then, not only are a lot of people having to reassess choices and they're saying, oh, this was cheaper, why didn't we do this before? But also the cheaper option has the sales force that's more ably, has the ability to actually get in front of that client, whereas another sales force is, in shambles. So I think there's disruptive technology taking share is not just kind of you're wiping the slate clean and it looks competitively better, but also the organizations that have it are also organizations that are more able to operate in this environment.
We'll have to leave it there. Thank you so much, Brett.